Coming forward to the next major step that was taken in this budget is this abolition of dividend distribution tax. So when you say abolishing dividend distribution tax, it is not taxed at the ends of the corporate. It is hereby taxed in the hands of the shareholders. So earlier it was kind of double tax, whereby you said it is not. It is taxed in the corporate as a dividend distribution tax in the hands of investors. If you have earned an income of more than 10 lakhs of dividend income from corporates, you will have to pay a tax of 10%. So hereafter, the proposal is that there is no more dividend distribution tax. The entire income will be taxed in the hands of individual or the investor at the normal rate, whatever they are eligible for, either the old tax regime or the new tax regime or the corporate tax structure. So whatever corporate tax structure they fall into, it will be taxed at the specific rate for residents. For non-residents, there is a separate tax category for a dividend income. So what has been abolished is the dividend distribution tax on dividend income and also the mutual fund income which is being distributed by the mutual fund unit. So these are abolished. So which means both these income which are earlier exempt under section 1034 till 10 lakhs is now henceforth removed. So it is taxable from rupee 1. Similarly, the income from mutual funds which was exempt under section 1035 is being no more valid. So it henceforth becomes taxable under the 56 section. So 56 was earlier taxing dividend income other than income which was subject to dividend distribution tax and income under the mutual funds. Henceforth, all these income will be taxable under income from other sources. So TDS applicability almost has been newly introduced. So earlier dividend TDS was not there on dividends because it was subject to dividend distribution tax. Henceforth, the proposal is to levy a dividend tax deduction of 10% for any income above 5,000. For any dividend income which is being earned, which is being paid by the corporate, need to undergo a tax deduction of 10%, be it your corporate dividend or the mutual fund income that is being distributed. It has to undergo a tax deduction of 10% before paying the dividend. So a new section of 194K has been introduced to levy TDS on income distribution from units, which has to undergo a tax deduction of 10% for the income distributed. For non-resident, it shall continue to be at 20%. Earlier, it was not required because it was exempt under section, because it was a dividend which was covered under 1150. Henceforth, it will be taxable at 20%. All dividends paid to a non-resident shall be tax deductible at 20%. The tax rate for this income is also 20% for the non-resident. So it shall continue to remain at 20%. And they have introduced a new section called ATM. It is similar to a provision whereby earlier dividend distribution tax has to be paid only on the net as far as holding company is concerned. Let's say a holding company is paying a dividend of 20, which already has invested in various subsidiary company, which has received a dividend from subsidiary companies, let's say for rupees 12. The holding company has to pay dividend distribution tax only on 8 rupees because the 12 would have already suffered dividend distribution tax. So the holding company has to pay only on the balance 8 because 12 has already suffered. So this was a concept which existed earlier under the scheme of 1150. Currently, they have said you can claim it as a deduction. So in case of a holding company is paying a dividend of rupees 20, the 12 whatever has been earned by from the subsidiary companies or any company. Earlier it was restricted to subsidiary company. Currently it is from any corporate which they have received a dividend of rupees 12. They can claim that as a deduction. So they need not pay income on the 12 rupees if they are already issuing a dividend. So what will be taxed is only on 8, not on the 20. So 20 will be the income, the 12 will be the income. Whatever they have paid as corporate dividend shall be allowed as a deduction under section ATM. So to the extent they have received dividend, they are free to give it to another corporate. So they are allowed to transfer dividend from one corporate to another corporate. So they have brought in a section called ATM whereby you can claim a deduction. So deduction is always restricted to the available income. It's not straightforward whatever you have received. To the extent you can claim it as deduction, to the extent of your intercorporate dividend is allowed under section ATM. So that's a new section they have bought. This ATM is allowed as a deduction even if you claim a lower rate of 15%, 22%, 25%. So it's allowed to be claimed as a deduction even in those cases. So that's one of the changes that has been brought in. So this is all about from the corporate angle. As we said, from the shareholder shareholders' viewpoint, it is going to be taxed as income from other sources. Earlier, it was tax deductible up to 10 lakhs. It was not taxable up to 10 lakhs with respect to corporate dividend. When it comes to income from mutual fund units, it was not at all taxable. Henceforth, this will be taxable straight from rupee 1 at the normal rate. So, whatever you are subject to tax, whichever tax scheme structure you fall into, it will be taxable at the same rate. So, that is for the dividend income. You can claim expenditure on those dividend income. If you have spent any expenditure which is directly attributable to earning this dividend income, you can claim it as a deduction, but it is restricted to 20% of your dividend income. So which means you cannot claim expenditure which is more than 20% of your dividend income. So this is the maximum limit that is being set forward. There are special rates for non-residents with respect to dividend income. If it's a dividend income from a global depository receipt, global depository receipt is an Indian company's kind of, let's say, similar to your FDs, which is listed abroad, which you are free to buy and invest. So such global depository receipt is taxable at any dividend from such global depository receipts will be taxable at 10%. If it is related to some specified industries, there is a separate provision which is into biotechnology or IT softwares, or falls under separate section, which is also taxable at 10%. For any of the foreign institutional investors, whatever we are talking now are individuals. If they are foreign institutional investors, that is corporates, they are taxable at a rate of 20% on the dividend income. So these are special rates for different categories of non-residents. So non-residents receiving income from a global depository receipt is taxable at 10. A foreign institutional investor receiving dividend income is taxable at 20%.
Just to understand.
Yes, sir.
It means to say, see, our previous understanding was like company by itself will pay a tax of 30% on 25 or 30. And then if the dividend has to be distributed, then they have to incur a DDT of effectively 17.5%. So 30 plus 17.5, 47% goes away. And when that reaches the investor hands, now he will have to pay more than 10 lakhs. He will have
correct,
to pay
10%.
So the dividend route was considered to be unattractive for
the investors.
So having lifted this, we can we go ahead and recommend even the private limited companies to go for dividend? Are they becoming on par with?
Yes, sir. Yeah, they can go for dividend, and with this, if they have, as we said, there is also this provision of ATM. If they are also having a group of entities, they can even try receiving dividend from their subsidiary companies, and finally pay it through the holding entity, whereby only on the net they will be liable for. Only the net will, all these can be claimed as deductions also, which will favor them. So it is beneficial for the corporates, the two group structures, to go for dividend options henceforth.
ATM, can you explain again?
ATM is basically you can claim the intercorporate dividends whatever you have received as an income. Let's say you have received dividend of rupees 12, which is supposed to be taxed in your hands if you are a corporate. But if you also have issued dividend, this 12 rupees you can claim it as deduction, provided your dividend is more than 12. So up to this 12 you can also claim it as dividend, which means the 12 is not taxable in your hands. You are just passing it on to the next shareholder. So that's a new benefit that they have brought under ATM.
So predominantly help a lot of this foreign subsidiaries.
Exactly.
Correct.
Yeah.
They can take home without
correct. Yeah. So it helps them to bring out the funds that lies with the corporates. So probably they would not have issued as dividend, considering all these issues related to DDT and even finally being taxed in the hands of shareholders. Now they are just going forward and say you are free to issue dividends.
But even though it is taxed twice, once in the hands of the company, another one in the hands of the investor.
At the end of the day, because it's what has been already suffered tax is what is at the end of the distributor.